Good day everyone, I'm Hugo Besaidenout, responsible for investment distribution at MFP, and I have the privilege of chairing the MFP Investment Committee. Welcome to today's MFP Outcome Matters, where I'll be your host. Thank you for joining us today and for your continued support of our business. I trust you will find this webinar insightful and valuable. Before we delve into the session, let me address a few housekeeping matters. We've applied for Continuous Professional Development or CPD points, recognizing their significance to you. To make sure your attendance is verified, kindly watch the entire session and provide us with your ID number in the CPD section. The event platform will be accessible until the end of June 2024, granting you ample time to revisit the content and secure your CPD points. In July 2024, you'll receive a separate email from Momentum Sales Academy containing your CPD certificate. Please feel free to pose any questions in the Q&A section, and our speakers will address them in real time or respond after the session. Okay, so let's kick off the session. In 2024, more voters than ever head to the polls, with 49% of the world voting this year in no less than 64 countries. That's a staggering number, and as we all know, with elections come uncertainty. Investment management can become tricky during these times, and it is important for clients and their advisors to remain focused on their long-term goals and ensure that we keep away from the noise. Today, our panel and portfolio managers will discuss how they are managing the house view solutions during this period of uncertainty. I will now hand over to our economist, Sanisha Pakarasamy, who will discuss the political scenarios and economic consequences. The stage is yours, Sanisha.
Thank you, Hugo. Hello, everyone, and thank you for joining us. The democratic stage is primed for a momentous year as an unprecedented supercycle of elections worldwide promises to reshape the political landscape in 2024. From established democracies grappling with rising populism and economic worries to fledgling democracies facing the test of legitimacy, voters in at least 64 countries will head to the polls this year. Among these are 8 of the most populous 10 countries in the world. This year's elections are set against a backdrop of rising authoritarianism. These are political systems that are characterized by limited civil liberties and centralized power. Although democracy is far from running out of steam, as was evident in Poland in October last year, surveys mark a retreat in democratic spirit. According to the Varieties of Democracy Institute, the quality of democracy enjoyed by an average global citizen in 2022 was back at the levels experienced in 1986. The perception of democracies being slow to respond to social demand has likely contributed to the splintering of the electorate away from centrist parties. In the post-World War global geopolitical structure, certain elections will hold significant importance. The headline election will be held in the United States in November this year, with a narrow result potentially inflaming existing tensions. Moreover, the European parliamentary elections in June could also deepen divisions, especially if radical right-wing parties gain more seats. While localized unrest is a key risk in this volatile geopolitical environment, there are wider-reaching consequences from these uncertain electoral outcomes for foreign policy, trade relations, and even global supply chains. South Africa stands as a microcosm of these global political trends. The upcoming general elections on 29 May hold the potential to profoundly reshape the nation's governance framework against a rising tide of global electoral uncertainty. Polls currently paint a precarious picture for the African National Congress, or the ANC, the nation's dominant party since the end of apartheid in 1994. The prospect of the ANC falling below 50% of the vote for the first time, as indicated by a number of opinion polling institutions, including the Brenthurst Foundation, the Social Research Foundation, and Ipsos, amongst others, is a stark reflection of growing public disillusionment. Deteriorating service delivery, crippling infrastructure woes, and a perceived lack of progress in tackling corruption have all eroded trust in the ruling party. socioeconomic inequality and job scarcity, as well as an unequal opportunity to quality education, have created a view that democracy has not delivered a better life for all. In 2004, when the country celebrated a decade of freedom, 59% were satisfied with democracy. Now, only 22% are satisfied with how democracy is working in South Africa. The Human Sciences Research Council, or HSRC, notes that confidence in national government fell from 69% in 2004 to only 23% in 2022. Trust in Parliament dropped from 65% to a mere 21%, and trust in local government went from 48% to a paltry 25% in the same period. The HSRC notes that the biggest falls in confidence have unsurprisingly coincided with high-profile government scandals. In response to government's failures in adequately addressing the nation's economic and social ills, there has been a surge in the opposition party landscape, with over 350 parties registering for this year's South African elections. Now, many of these are led by former political figures who have defected from established parties aiming to capitalize on voter dissatisfaction. While this signifies a potentially vibrant democracy, it can also be interpreted as a symptom of deep-seated discontent with the existing political system, and this can lead to voter apathy. Global voter turnout has been in decline since the 1960s, partly owing to generational replacement, where older voters are more likely to view casting their ballot as a civic duty. Rising inequality also plays a significant role in discouraging citizens to vote. The level of voter engagement nevertheless meaningfully impacts the integrity of the democratic process. Research undertaken by the Journal of World Politics indicates that decreased voter turnout results in skewed socioeconomic representation, biased public policies, and reduced government accountability. It can even create conditions for increased patronage. Promisingly, the number of registered voters has increased appreciably in South Africa from 18.1 million in 1999 to a record 27.8 million registered voters for 2024. However, a significant portion may not participate in the vote. Out of the 26.8 million registered voters for the 2019 general elections, only 17.7 million votes were actually cast. This suggests that more than 9.1 million people did not turn out on the day to vote. This left voter turnout below 66%, largely driven by youth disenfranchisement, which we think can be attributed to unemployment, corruption, and poor service delivery. However, with this year's national and provincial elections more hotly contested than ever before, we could potentially see a revival in turnout levels with a higher number of youth registering to vote. The 18 to 39-year age band of registered voters accounts for more than 40% of the voters' roll this year. Moreover, the possibility of the ANC falling below 50% could rally the opposition base in the country's urban areas in particular. The potential shift in political power, as highlighted by recent polls, could usher in a multi-party governing landscape, possibly at a national level, which would be an historic first for South Africa. While progress towards democratic pluralism is a positive development, concerns linger. Coalitions have a checkered past at a local level, with many urban centres experiencing ineffective governance since 2016. After the 2021 elections, 70 municipalities experienced a hung council necessitating coalitions. Between 2021 and 2022, metropoles such as Nelson Mandela and Tshwane experienced a collapse in administration, which tarnished the nation's confidence in a multi-party democracy. While many coalitions at the metro level since 2016 have been notably unstable, there are nevertheless a number of well-functioning and stable coalitions established in municipalities throughout the country. The Government Performance Index, conducted by Good Governance Africa, factors in things like administration, governance, planning, management, and service delivery when ranking South Africa's municipalities. Standard Bank Group Securities, or SBG, highlights that out of the 20 top-performing municipalities of 2021, 4 were governed through coalition governments. A number of local government coalitions have experienced disintegration and a reconstitution in South Africa due to parties using them as a political battleground between elections. In comparison, constructively institutionalized versions of coalition governments have emerged where there's been a sense of shared national interest and policies. Global examples of successful coalition building include Austria, Germany, Japan, Malaysia, and Chile. The Centre for Social Change at the University of Johannesburg notes that coalitions can work more effectively in countries where there are first minimal ideological differences between parties, secondly where there hasn't been a dominant party in charge for a long time, and thirdly where opposition parties are not weak and fragmented. Programmatic alignment is thus crucial for coalition arrangements to be successful in South Africa. The national and provincial election outcomes are also likely to reflect new trends. A shift away from emotional loyalty to established parties has been evident in split voting trends. This is where voters strategically choose different parties for national, provincial, and local government ballots. This points to a more nuanced political landscape. The battle for urban areas will likely be fierce, with the ANC expected to retain dominance in rural areas. Gauteng and KwaZulu-Natal, however, stand out as potential battlegrounds where coalition governments at a provincial level seem likely. While uncertain at the time of filming, should the courts rule in favor of former President Jacob Zuma's Mkhonto weSizwe or MK party to remain on the ballot, they will pose a formidable threat in KwaZulu-Natal given the high concentration of the Zulu population in that province. With Gauteng and KwaZulu-Natal accounting for 44% of the country's population and 49% of the country's GDP, election outcomes here are viewed as pivotal. The ANC's stronghold in the traditionally rural bases, nonetheless, will likely carry it comfortably over the 50% mark in provinces like the Eastern Cape, Limpopo, Northwest, and even Mpumalanga to a lesser degree, given the entrance of the MK party on a crowded political stage. Moreover, by-election data points to trouble for the official opposition party, the Democratic Alliance, or DA, in the Western Cape, as support for the Patriotic Alliance, the National Coloured Congress, and the Good Party have increased. Moreover, the DA's initial steadfast support for Israel in the Gaza war may see some voters defect to the ANC. Recent polling results suggest sustained pressure on the ANC. The results are also flagging limited growth for the DA and the economic freedom fighters, with parties outside of the top 3 potentially collectively securing more than double their share of the vote compared with 2019. According to SBG Securities, a number of potential key election outcomes are on the table at the time of filming. In the most probable scenario, which SBG attributes a 60% probability of materializing, SBG notes that the ANC would garner between 43% and 47% of the national vote, requiring them to partner with a mid-sized coalition partner such as the Inkatha Freedom Party. In our view, if this scenario were to play out, it is likely that the direction and the pace of structural reform would be broadly kept intact given the closely linked ideologies of the ANC and the likely coalition partners under this scenario. In the next scenario, SBG Securities sees the ANC securing 48% or more of the votes. This scenario holds a 1 in 5 chance of occurring, according to SBG's analysis. If the ANC manages to get over the 50% line, they would not require a coalition partner. However, if they drop below it, they would need the support of a smaller party. While this would imply lesser control for the minority party, it would still allow for a strong coalition to govern the country. SBG notes that each 1% of the vote equates to 4 seats in parliament, so a 48% win by the ANC would require the votes of only 8 MPs to secure a majority in parliament. As such, the direction and pace of structural reform would, in our view, continue on the current path. In the remaining scenario, which holds a 20% probability of transpiring, the ANC gets less than 42% of the vote. A plethora of election outcomes could evolve from here. The most market-friendly of these outcomes would likely be an ANC-DA coalition, under which we would likely experience a step-up in governance and accountability, a crackdown on corruption, increased investor sentiment towards South Africa's economic prospects, and a revival in fixed investment. This would ultimately lead to a higher growth path for the country, enabling a reduction in unemployment and poverty. In an alternate outcome, the ANC could partner with the multi-party charter. SPG notes that under this scenario, there would be support to protect the Constitution and critical institutions such as the Reserve Bank, the South African Revenue Service, the National Prosecuting Authority, and National Treasury. While authorities would encourage private sector investment in this scenario, we believe that structural reform efforts would lag given the number of political constituents involved and their difference in views. SPG also considers the option of the ANC partnering with the EFF or the MK party, or even both, in the scenario where the ANC drops below 42%. In our view, this would result in the most economic damage, given some of the more radical views expressed in the EFF and MK parties' manifestos. A shift to the left in policies could result in a souring of international relations with the West, capital flight as confidence in SA's future growth plummets, and a more divisive society. In this scenario, we would likely see a lower fiscal restraint being exercised, debt soaring to higher levels, and a further weakening in the currency leading to elevated inflation. Moreover, any abrupt or unconstitutional changes could undermine the country's democratic institutions and its legal framework in this scenario. These resultant deficient socioeconomic outcomes would likely lead to a loss in support for this form of government by the time of the next general elections held in 2029. In the last alternative, under the scenario in which votes for the ANC fall below 42%, a minority government is considered. On the upside, a minority government allows for a higher level of accountability, given that key economic decisions require broader scrutiny and support. Additionally, a more inclusive outcome can be reached given the diversity of views involved. Nonetheless, a minority government comes with its own set of challenges, such as political instability when struggling to pass key pieces of legislation, or policy compromises leading to a watering down of growth-enhancing priorities. Moreover, political deadlock can ensue, leading to a loss in confidence. Taking these probabilities of these scenarios into account, there is a strong chance that Cyril Ramaphosa will remain as president of the country. A survey from Afrobarometer shows that citizens polled are more satisfied with Ramaphosa than they are with government in general. Ramaphosa enjoys a firm level of support across the provinces, the leagues, the National Executive Council, and the ANC's alliance partners. However, if support falls significantly for the ANC in the upcoming elections, the probability of Ramaphosa securing a second term as head of state would indeed be lower. The uncertain political climate casts a long shadow on the economy and has acted as a major constraint for investment prospects in the country for the better part of a decade. An evolving political spectrum and economic projections underscore a nation in flux. The outcomes of these elections will not just determine governance, but also shape the economic discourse, depending on political players' willingness and ability to take the difficult decisions needed to enable a higher level of growth while preserving fiscal prudence. South Africa's future hinges on bridging socio-economic divides, navigating logistical hurdles, and harnessing the power of a politically engaged and empowered society. Your vote truly counts. I thank you for your time.
Thank you, Sanisha. Next is a panel discussion moderated by our Chief Investment Officer, Mike Atsitz. The panel will discuss managing portfolios during uncertain times. Welcome, Mike and panel. We really look forward to your insights.
Welcome to our panel discussion about managing investment portfolios in times of uncertainty. With me today is Keegan, a bond portfolio manager at Momentum Investments, Herman van Papendorp, head of macro strategy and research insights, and Pello, our head of listed property. So, in the current environment, there's a lot of political and economic uncertainty. Globally, inflation seems to be stickier than everybody expected, and interest rates are staying higher for longer. Going around the world, approximately half of the democracies by population are going through some sort of election. So there's a lot of political and geopolitical tension and uncertainty. And in the local environment, we also have elections tomorrow. So there's a lot of uncertainty and angst in terms of what's going to happen in the future and how do we navigate and manage portfolios in this environment. So starting from a macro perspective, my first question is going to be directed to Herman. Just from your view, a local and global macro perspective, how would you suggest managing portfolios in this environment of political and economic uncertainty?
Mike, philosophically, the only thing that we can really be certain about the future is obviously the fact that it is uncertain. Mm-hmm. I think as investment managers, we need to have the humility to really realize that the reality is that financial markets are largely unpredictable. But the silver lining in all of this is that uncertainty also provides you with investment opportunities. When market prices move significantly away from the range of probable outcomes that are likely, and that you can actually then exploit as a fund manager in this kind of environment. Now, this normally happens when you either have excessive pessimism in the market or you have excessive optimism. Remember that the father of value investing, Benjamin Graham, used to say that the intelligent investor is a realist that buys from the pessimists and he sells to the optimists. Now, if you look at financial markets, they are always uncertain, and a lot of the time they are very much volatile. But I think 2024 is quite an interesting one because here we've got the added uncertainty of heightened political risk. And if we have the environment here where more than half of the world's population actually this year are going to be heading to the polls, this is the highest ever proportion of the global population that's actually going to have some sort of a vote one way or another, either in regional elections or in country elections. So this adds another angle to political risk this year, which is different from other years and maybe will increase for global financial markets the potential for election-induced volatility that we need to deal with this year.
So there's a lot of uncertainty, and as the saying goes, smooth waters do not make good sailors. So definitely we are not in a time of smooth waters. And a big facet of investment markets, apart from valuation and what's the right time to invest, is the duration of your investments and investor sentiment. So just in terms of the context of the current economic and political uncertainty, there's going to be a lot of sentiment driving investor behavior. Just your views in terms of what are the implications for investment markets and how should we go think about the opportunities set going forward?
Thank you, Mike. I think in thinking about the implications of political uncertainty on investor sentiment and market behavior, it's important to recognize that it's multifaceted. Firstly, there's obviously a recognition that we don't know what the potential outcome is going to be from these upcoming elections, which party is going to come on top. And also, in addition to that, what policies this party or these parties are actually going to adopt and the implications of those policies on the economy and in markets. So these are very difficult things to predict. But I guess also it is important to recognize that, when sentiment turns negative, there's confidence wanes. So people generally take a longer term time to actually make decisions. So if I bring it back to the real estate space, what typically happens is transactional activity comes to a slowdown. Leasing volumes also slow down as well. And again, bringing it back to financial markets, the same also applies, that volatility increases as well as risk premiums also increase, which are all signs that markets are concerned about the potential thing that might happen in future that might have an impact on markets. Typically what happens during that period of time is that most investors will then choose to sit on the sidelines, either sell some of the securities that they hold in their portfolios to up their cash positions. And what that invariably does is that it creates selling pressure on markets. So I think what is important for us is to remember that the leading up to the elections and potentially a week or two post-elections, there's going to be heightened volatility, as Herman initially mentioned. But for us, we think that that presents an opportunity to identify and acquire good quality companies at discounted prices in this market. So that's actually what we will be looking out for in this market.
So you really need to look through the cycle and invest for the long term. And a lot of volatility gives you good investment opportunities. You touched on cash a little bit. So my next question I want to ask to Keegan, who should be managing the stable and steadfast asset class bonds, which clearly it has not been. There's been a lot of volatility in global bonds, interest rates being quite sticky, inflation being sticky. We've seen yield in South African bonds at high levels, so it should be a great investment opportunity, but with the political overhang and risk in the market, we've not seen the returns that we're expecting out of bonds. So just your view in terms of the current context and looking through the elections, is South African bonds and global bonds an investable asset class? Are we going to be rewarded for living through the current volatility?
Thank you, Mike. So bonds have been a challenging asset class to manage over the last couple of years, especially this year, given all the political noise, geopolitical noise, and I think specifically in terms of the election that's coming up. But I do think in terms of the risk premium that's baked into the nominal bonds is specifically largely a result of South African specific risks. And we're at one of the worst times in terms of risks at the moment. The forward rate market has basically repriced the entire interest rate cutting cycle, and as a result, within the South African yield curve, interest rate cuts this year has been totally priced out of the market, which is, to us, it's a good thing, because if inflation decides to tick down or closer to towards the target bands, what we would see is in any event where any of these central banks, whether it's the Fed or the SARB, becomes a bit more dovish, we could see that yield curve reprice quite significantly, and it can unlock that risk premium that we've seen in nominal bonds. And I don't want to put percentages on it, but we could see bonds trade a lot lower. If you look at where bonds are at the moment, a 10-year bond is trading at about 12, 14 versus where CPI is. It's almost CPI plus 7. Bonds shouldn't trade, to me, bonds shouldn't be trading at these extreme valuations. And for us, we need to buy the point where the bonds offer the most value. Now, I can't say that it won't go to 13% if there's anything fundamental that happens, but what I can say is, as a valuations team, we need to buy bonds at this point in time. But unfortunately for foreigners, they have been selling off our bonds as a result of all the negative political and geopolitical risks across the globe and emerging markets. But I do think that any small dovish movement within any of the central banks, we could see yields trade a lot lower. So
currently cash is king, and bonds are clearly the prince in waiting. So the time will come. We just need to get through the current environment.
Exactly.
I mean, a big factor influencing the pricing of listed property is currently where bond yields are. And it seems that bond yield pricing are very reflective of the uncertainty and political uncertainty we've seen in the local market. So just, Pella, your view in terms of the listed property, the impact of the current yields on the valuation of listed property, and what is the opportunity set for listed property looking through the cycle?
Yeah, thanks for the question again, Mike. So I think our view is actually quite different from the views presented by Keegan, because if I think about the rally that we've seen in listed properties since the fourth quarter of 2023, all the way through to Q1 of 2024, we've seen a massive rally in the asset class, to a point where we felt that actually the sector is priced at a premium, and we needed to see a little bit of correction coming through. We have seen subsequently a bit of a sell-off, but we we haven't observed any election risk premium attached to listed property, the same as Keegan sort of mentioned on the bond side of the equation. But given where bonds are trading at 12% and earnings yield on property at around 10.5%, we think that there is definitely a likelihood that you'll potentially see property in its correction also adjusting closer to where bonds are actually trading at currently.
Okay, so Harman, you've listened to the inputs from Pela and Kigo that just talked about some of the detail of their specific asset classes, but you have the opportunity to have a more macro view, and looking at the inputs and looking at the current context and going forward, how would you suggest or how would you think about managing a multi-asset portfolio in the current environment?
Mike, I want to sort of at the outset sort of just take a bit of a step back and almost say that, you know, what we need to realize that at Momentum Investments, we really remain steadfast in our approach of taking a very long-term investment horizon. And we try not to have knee-jerk reactions to short-term events like politics and so forth.
Time in the market.
Yeah, exactly. And so that's the first kind of factor that we always take into account. I think also we try and to remain focused on our primary strategic investment objectives, our goals down the path, despite these transient political noises that we'll sort of see from time to time. So I think, you know, we like to remain focused on, you know, fundamentals of companies, on long-term fundamentals, on valuations, and that is really the driving force for our views on specific asset classes, rather than sort of having these kind of short-term political noise reactions to what is sort of the events of the day. Nevertheless, you know, if we do look at how we deal with political noise in our portfolios and other uncertainties, I think we fortunately have a number of tools available to us to actually manage our portfolios across asset classes, really. I think the first thing that we do at Momentum Investments is we do a full-scale scenario analysis over a longer-term time scale, because we don't want to have just one specific view that we align ourselves to, because that specific view could very much be wrong. So we do like to assess a number of potential developments that could play out over the next number of years in our portfolios, and then try and gauge, you know, what could be the market reactions if one of these scenarios does play out in our portfolios, because that gives us the opportunity then to change our portfolios at the time, you know. So we won't be totally surprised if scenario 1 plays out relative to scenario 2, because we do know that how the markets will react, and that gives us that almost dynamism that we can actually adjust our portfolios in this kind of framework.
And just quickly, I mean, in the scenario work, and we'll come back to that a little bit later, even if there is multiple scenarios, what you identify through the scenario work is potential flags to look out for, and once you start seeing those flags and getting an indication of which scenario might actually actualize over time, you can make the necessary adjustments, but important that it's not knee-jerk reactions. And it's got to be careful, considered, and long-term views that we ultimately bake into the portfolio. You know, tactical around the edges is a little bit different, where you want to be a bit more opportunistic and take the opportunities that come. But your scenarios is definitely a tool for broadening the mindset and thinking about what are the potential outcomes, and, you know, prepare yourself how to manage portfolios as you start seeing one scenario might be the winner versus the others.
No, correct. And this also changes over time. I mean, we see it when we do our annual scenario exercise, which we call a sort of a medium-term scenario exercise, where we look at kind of paths over the next 5 years for economic variables, paths for asset class returns. And we see that these things do change over time. We actually attach higher probabilities to certain scenarios as time goes on, because we see, you know, a certain scenario suddenly becomes a higher probability event than another scenario, which might have been different a year or two ago when we did the same kind of exercise. And sort of we just finished recently our medium-term scenario exercise, and quite interesting results coming from that. We've sort of built 3 main scenarios, and we look at the kind of paths of these economic variables and asset class returns in that. So scenario analysis is definitely one of the aspects that we can look at. Diversification is another one. I think, if we look at diversification, I mean, that's the one free lunch that we do have in investments. And I think, again, when we look at diversification of your portfolios, it means not only across asset class, but also across regions. So, again, if you look at the cross asset classes, what we want to have is significant exposure to different asset classes that behave differently in certain scenarios, because that gives you that downside risk protection almost when you have those kind of asset classes in your portfolio. And across regions, we have obviously South African exposure relative to offshore exposure. And these two main asset classes, SA versus offshore, they behave very differently in different scenarios, depending on what the currency does and whether there's a risk on or a risk off environment globally and locally. But not only that, I mean, if you look at the asset classes as well, I mean, some of these asset classes are negatively correlated. I mean, often it's the case that bonds and equities are negatively correlated. They're not always. I mean, let me just make that clear. But a lot of the time they are negatively correlated. So you want to have bonds and equities, global and local, in your portfolio to sort of have that diversification. But also some asset classes are totally uncorrelated. I mean, gold is a great example of that. That's uncorrelated with other asset classes. So you want to have some exposure to gold so that if more positive scenarios don't play out, that you actually at least have that as your natural hedge in your portfolios, to have gold in there. So diversification, very important. I think another thing, but we can obviously always consider is having hedging in our portfolios. It's important to actually have that ability to hedge some part of your risk profile against political risk, for instance, to have a hedging in there so that can protect your downside, but it also doesn't remove the potential upside if there's actually a positive outcome coming through from a political event or whatever. And I think, another sort of tool we have with us is dynamic asset allocation. We used to call it tactical asset allocation, but I like to have the word dynamic in there because it does show you that we can sort of react to what happens in the market. So again, we'd like to monitor news flow in the markets. We like to monitor political developments in the markets to see, do we need to make some changes, shorter term tactical, as you mentioned earlier, in our portfolios relative to our strategic long-term kind of profile of our asset class exposures. And that gives you that opportunity to actually do that if you have dynamic asset allocation. And I think the final thing that I want to mention is that, we always want to have some liquidity in our portfolio available so that you do have either cash or other liquid assets available so that you can then make use of opportunities that do come forward as uncertainties play out in the market. So I think when we use all these kind of tools and we take a very much a proactive or an adaptive kind of approach into our investment decision-making process, then I think you have this ability to maybe protect the downside, but actually have that opportunity to participate in the upside as well when more positive scenarios play out.
And ultimately, we don't have a crystal ball. So, the uncertainty, the risk and opportunity, we've got to be very circumspect and be humble enough to know that we're not going to make the right calls necessarily all the time. So diversification and some of the other strategies are critical. And even within particular asset classes, you could have a broad range of diversification within the sub-asset classes. So if I'm thinking about the health of the South African government and its finances versus the health of South African corporates, it's a really chalk and cheese. And very often you have a conversation that when you do a rating on a corporate, if it wasn't for the sovereign ceiling that a company can't be rated better than the country, we'd have a lot of corporates that are better rated than the South African government because they've got healthy balance sheets and they're not necessarily that linked to the South African economy. So my next question is for Keegan, just talking a little bit about the disconnect that we're seeing between the credit markets or the credit components of the fixed income market and the sovereign parts of the fixed income market. What are your views around the opportunities that are presenting themselves to invest in specifically credit at the moment?
Thank you, Mike. I think it's very important. Herman has mentioned the diversification part. So diversification as in fixed income space, specifically for credit. Credit tends to react a lot differently to the traditional government bonds. And it's a similar situation on a global basis. So if we look at credit as an example, on a global scale, there's been about $6 trillion that has been chasing credit opportunities. And as a result of that, we've seen the credit spreads on a global basis narrow quite significantly. And the reason for that is a lot of the market is concerned around the government's monetary policy, communication around monetary policy on a global basis, and they're chasing yields from a corporate perspective because you can get quite a good yield pickup on those corporate names from a global perspective.
So investors really want discipline in their investments, and what we've seen with a lot of governments is they're anything but disciplined with the printing presses and the auctions, whereas corporates tend to have a little bit more discipline, and it's that attractive opportunity set that investors are trying to access.
Exactly. And so if you think also about the South African market as an example, so we have the same problem in South Africa where we have a pool of money that is chasing so few credits. And as a result, the supply and demand dynamics within the South African corporate market has been it's offset because, and then spreads are so tight because of that search for yield. So we sit in a position where corporates have good balance sheets, they're unlevered. Some of the companies, if you look at like the likes of your ShopRites and the likes of your Pick n Pays, they're not coming to the market to raise debt because they have sufficient cash on their balance sheet, so they don't need to raise debt. But that doesn't help us in our adventure for trying to find credit. So I think credit is exceptionally important in our portfolios, but just the demand and supply dynamics has made it very difficult, and those spreads globally and locally has come a lot tighter just because of that demand.
And notwithstanding that, there's a healthy chunk of credit in your bond and generally in our fixed interest portfolios. And just coming back to you, Pella, you know, we've talked a lot about risk management and the opportunity sets, and, you know, a volatile time might be the right time, you know, to purchase an asset and hold it for the future. So just in terms of your asset class, the listed property sector, what do you think about the risks and the opportunity set? So how should we approach it as part of a broader, diversified portfolio?
I think what we're doing in the portfolios now, given the uncertainty that exists in the market, is that we've increased our allocation to high quality companies that are paying dividends. Because you tend to find that during periods of volatility, these companies, the dividends that they're actually paying out, act as a buffer against capital losses when there's volatility in the market. So that's what we're doing. We're buying high quality, high yielding property companies in the portfolio. But to Herman's point also, in addition to that, we're also looking at it from a diversification perspective, that in periods where there's this uncertainty that's playing out, there's the rand typically also sells off. So what we're doing is we've also allocated a portion of the funds into these offshore companies that operate in regions such as Western Europe and Eastern Europe, with the view that if our currency depreciates, there's a benefit of that we're getting in the portfolio as well.
I mean, ultimately, we're not going back to the Stone Ages. So people need places to live, they need places to work, they need places to manufacture. So, I mean, property is going to be around, and there will be investment opportunities. And you need to think about it in the context, even with some of the headwinds we currently see, well, not recently, but in the longer term, that it is an investable place to be, and it does have an important role in a diversified portfolio. But Arman, you might have mentioned scenarios a little bit earlier. So I just wanted to ask you quickly, can you just run us through some of your most recent scenario work? And, you know, it might not be one crystal ball, it's 3 little crystal balls. Just run us through your thinking there and what we should be on the lookout for.
Sure, Mike. I mean, we've run 3 scenarios. We have identified 3 scenarios at the moment. I mean, in our base case, which we call muddle through, we see there that global growth is slightly lower than pre-pandemic levels, but inflation interest rates somewhat higher. On the local domestic front, we see the ANC probably having to go into a coalition government with a number of smaller minority parties.
But still being able to arm wrestle them.
Yeah, but and still continuing this kind of status quo of market reform that we have at the moment.
Getting better slowly.
Yeah, unfortunately not a great environment in that kind of base case, but it's still a bit of a risk-on environment globally, so your kind of risky assets still do somewhat better. So, the assets that we would favor in our base case would be South African and emerging market equities, also South African nominal bonds and South African ILBs in Keegan's area. But we would avoid things like global cash and global nominal bonds. In our best case kind of environment, where which we call reflation, that's an environment where it's totally risk on globally, where your global growth, global interest rates, global inflation, they all normalize to pre-global financial crisis levels. So it's very much a strong risk on environment. You want to favor the risky assets around the world, including South African assets as well. So there you want to favor, very much an environment where you want to have still South African and emerging market equities, South African nominal bonds, but then Pello's listed property starts coming up as a good asset class to own in that risk-on environment. But there you would want to, again, stay away from nominal global bonds and global cash. In our downside risk scenario, very negative kind of outlook, there you really have deflation in an environment where your growth globally, inflation and interest rates, they all plunge towards zero, even below zero. That's very much a strong risk-off kind of environment. In that kind of environment, we also have domestically that the ANC loses a lot of their support, so much so that they've actually got to go into a coalition with probably a larger leftist kind of populist party. So you could see more populist policies come through in that kind of framework. And in that kind of environment, with this risk-off scenario, very much gold comes to the fore as an asset class that you would want to favor. Probably in that environment, global bonds as your sort of risk-off kind of asset will come through as a positive. And what you would want to stay away from there is global listed property and then local listed property as well in that risk-off kind of scenario, and also developed market equities because of the valuations that are really not in their favor and they don't do well in a global risk-off environment.
I mean, there's definitely risk and opportunities, and hopefully we do get a stable center with coalitions around the margins. I think at a national level, that will be the story. It's going to be much more interesting if we look at a provincial level, but tomorrow and the next couple of weeks will really give us insight in terms of how that plays out. But definitely a long-term investments is a long-term gain, and you need to think through the shorter term. Before I close the panel, if I can ask my panelists for some last thoughts, if they have any, so I'll just go around. If I can start with you, Keegan, any last thoughts for our investors and clients and advisors out there?
Okay, thanks, Mike. So I think just from my point of view, nominal bonds, inflation-linked bonds in the short end do offer value. We're trying our best to ensure that we get some credit as well in the portfolios to create a diversification. And I think that, to Herman's point, if Herman's base case comes to the fore after the elections, I think nominal bonds can easily unlock that domestic risk premium.
And yields come down, and capital comes back.
Exactly.
Your side, Herman?
I think added to that very much local equity as well, because they've also got a big risk premium in there. And maybe then a final point from me, Mike, the other diversification angle which we didn't discuss today is obviously the fact that we have private assets as well, your alternative assets like hedge funds, private equity, infrastructure. Those are things that also feature in our portfolios throughout to really also hedge our bets against the potential outcome that we will have politically.
And yourself, Pello?
Yeah, thanks, Mike. So we focus on fundamentals. And I think in this period where there's uncertainty, that's what investors should actually be looking out for, focus on fundamentals. Yes, there is political uncertainty, but in our view, this is potentially something that will pass. And post that, markets will come down, volatility will come down, and there will be opportunities in the market for you to acquire good assets at discounted prices.
So thank you, panelists. And in closing from our side, clearly we're in a short-term uncertain environment, but investment is a long-term game. And when there's uncertainty and volatility, if you look through the emotion, know that in time things will be okay, and there are going to be good investment opportunities. So diversification is key, valuation is key, and in staying invested for the long term is key. Thank you for joining us in the panel. I really enjoyed the conversation, and thank you to my panelists for participating.
Thanks, Mike.
Thank you to our panel. Ronnie, who co-manages the MFP Fund of Funds and model portfolios, will discuss embracing multi-asset opportunities in uncertain times. Take it away, Ronnie.
Thank you, Ihu, and good day to everyone dialing in today. Sanisha has already provided quite a detailed overview of the economic landscape and what to look out for in the coming months. Looking back at Q1 of 2024, we can also see the impact that the main economic themes has had on markets. As expected, market behavior continued to be driven by the interest rate cycle, inflation, and geopolitical tensions, which have been rising in the Middle East and is now dragging out past the 2-year mark in Russia-Ukraine. Overall, investors have lowered their expectations for significant rate cuts in 2024 relative to what the markets were expecting and pricing in during the latter part of last year. Inflation continues to remain stubbornly high in developed market economies, and up to very recently has been coupled with higher than expected growth, particularly in the US. This combination is holding back the Fed from committing to rate cuts in the near term, and the first rate cut is now expected by September, or potentially even later in Q4 of this year. Staying with geopolitical risks, 2024 is also a massive year for elections. And the interesting statistic that you would have no doubt heard ad nauseum by now is that nearly 4 billion people are going to the polls this year. Certainly a good time to be in the printing business if you have a government contract. This is the highest number in over 200 years. And as with all elections, there is an increased risk of political instability and therefore market volatility. So how did markets behave during Q1? Well, starting with a global perspective, equity markets continued their upward trend from late 2023 into the first quarter of 2024, with developed markets outperforming emerging markets once again. Despite rate cuts being postponed, current developed market equity is still pricing in a soft landing. The next chart focuses on global developed market equity behavior in the days post the Fed's last rate hike and confirms the current market, there shown in yellow, to be on the no recession path. If indeed no recession occurs, there is further potential upside, but at the same time, the market is in a vulnerable position and downside risk remains if the market is wrong about a recession. Looking now at asset class returns for the quarter, global equity, as measured by the MSCI All Country Index, returned 12% in Rand terms. Developed markets were led by US equity, given the sheer size of the US in the index. The US was again led by big tech and the AI theme, which is expected to drive more productivity and therefore growth in the economy. The Magnificent Seven has continued to be dominant, although we did see some cracks starting to appear, with Apple and Tesla down 11% and nearly 30% respectively over Q1. Both Apple and Tesla are facing stronger competition, and Chinese EV manufacturer BYD, for example, has now overtaken Tesla as the largest EV producer in the world. SA listed property managed to post a healthy 3.8% return for the quarter, still benefiting from that strong re-rating we saw in Q4 that managed to persist into January. However, the asset class came under pressure in Feb and March as the reality of the growth prospects, as well as delayed interest rate cuts, started settling in. Similarly, global property has declined 1.5% in dollar terms for Q1, but given the 3.5% depreciation of the Rand, managed to post a positive 2% return in local currency terms. Resilient inflation data saw global bond yields rise in Q1, leading to a negative return for global bonds in dollar terms. This asset class, however, also benefited from the currency depreciation to return positive 1% in rands. South African bonds also followed global bond yields higher, and with the added negative sentiment of a deteriorating fiscal outlook, coupled with the uncertainty and potentially a pivotal upcoming national election outcome, meant that the SA bond market contracted by nearly 2%. Despite a 13% rally in resources in March, SA equity was the worst performing asset class over the quarter, delivering negative 2.3% for the 3-month period. Financials, followed by resources, were the leading detractors over Q1, as global appetite for South African equity remains low, coupled with an unclear outcome for China as the largest consumer of South African commodities. Also noticeable in the longer-term asset class returns is the lack of meaningful outperformance from SA equity over inflation. Over 5 years, SA equity has delivered CPI plus 2.4%, and over 10 years, that figure drops to just CPI plus 1.3%. Global risk assets, such as equity and property, have consistently outperformed, coupled with a persistent depreciation of the rand. This leads me into the next chart, where we look at the delivery of the high, medium, and low ASISA multi-asset class averages over rolling 5-year terms. The chart shows that it has been challenging for the average multi-asset class fund, regardless of aggressiveness, to achieve 2% to 4% real, or above inflation, for quite a number of years now. Although the trend does seem to be improving of late. This may have your clients wondering if they should not rather move to a cash or income fund, which offers arguably the same level of return, but with a lot less risk. And to answer that question, we can consider the last year as one example, which shows just how quickly global and local markets can turn in as little as a few months, emphasizing again why it is so important to remain invested. This is particularly important in the current environment, where valuations in both South Africa and emerging markets seem to be finding a bottom. Next, we turn our attention to the returns of the Momentum Focus Fund of Funds and the Equilibrium MFP Focus Model Portfolios. Fund returns for the quarter were positive across both the Fund of Funds and the model portfolios, ranging from 1% to 2.5%. Within the ASISA peer group rankings, the Focus Fund of Funds ended first or second quartile across the board. The Focus model portfolios now have surpassed a 3-year live track record, and 1 and 3-year returns remain well aligned with inflation-linked benchmarks, as well as the broader ASISA peer groups. Although, linking back to my previous slide on the market environment for multi-asset class funds, benchmarks of CPI plus 4% and higher have been hard to attain over the recent long-term cycle, as can also be seen in the more aggressive solutions over the longer-term periods. Nevertheless, the funds remain invested according to their strategic objectives over the long term, while taking suitable tactical positions based on the prevailing market conditions. So what worked well over quarter one were our overweight positions to global equity and global cash within the fund of funds, as well as overweight positions in local property within the model portfolios, combined with outperformance from selected mandates within both fund ranges. In absolute terms, the global mandates in the solutions were the largest contributors to returns. Global equity mandates had mixed results, with the Momentum Sustainable Equity Fund, introduced in the Focus Fund of Funds a little over a year ago, being the best performer during quarter one, with 13.6% outpacing the MSCI World Index. The fund benefited from underweight positions to Tesla, as well as overweight positions to Nvidia, but factor premia drove the bulk of the returns. Both the Momentum Emerging Markets Equity Fund and the Coronation Global Emerging Markets Fund also outperformed the MSCI EM Index by a large margin. The Momentum Global Growth Feeder Fund, as well as the Future Trends Fund, both added meaningful positive returns, but underperformed the very concentrated index, largely owing to those smaller positions in the Magnificent Seven. The global fixed income mandates all contributed positively. Overweight duration in the Momentum Global Fixed Income Fund resulted in the fund lagging the index over the quarter, while the passive OneVest Global Government Bond Feeder Fund was marginally ahead of the index. Somewhat less successful was the iShares Global Property Tracker, which lagged the FTSE Nareit Property Index by 2%. Now on the local front, despite a negative return from local equity, the Momentum Focused Equity Blend outperformed the index to end the quarter 1.5% lower, 80 basis points above the Caps Wix index. During quarter one, the models completed their transition into the now 5-manager equity lineup. Fairtree Equity was the best performing manager with -1%, followed by Truffle Equity with -1.1%. Within the Fairtree Fund, the consumer discretionary sector was the key contributor to performance, with positive contributions from AngloGold, Goldfields, Naspers Process, as well as British American Tobacco, to name but a few. Truffle, on the other hand, benefited from good stock selection across telecoms, banks, as well as overweight positions in selected gold miners. Within property, the local global-focused Catalyst Flexible Property Fund ended the quarter up 1.4%, although 1.8% behind the composite benchmark. Their underweight SA property and overweight cash position contributed negatively to performance relative to the benchmark. Moving on to fixed interest now, the Momentum Flexible Fixed Interest Fund underperformed the Albee, driven by overweight exposure to the 12-plus years sector of the yield curve, where both underlying managers, being Coronation as well as Prescient, are seeing the most value at the moment. The short end of the yield curve was the strongest performing sector with a return of 81 basis points. All the other sectors on the yield curve were negative over Q1. At the same time, the ILB and listed property exposure within the Momentum Flexible Fixed Interest Fund, although relatively small, both added positively for the quarter. And then lastly, looking at local cash, Momentum Diversified Income Fund was in line, while the Momentum Enhanced Yield Fund outperformed the STEFI. So how are we positioned for the current market environment? Broadly speaking, given the heightened event risks of the upcoming elections, coupled with the ongoing geopolitical tensions, wars, as well as a delay in the rate cutting cycle, we are marginally tilted to an overweight defensive position. We also remain overweight global assets in the fund of funds, and we will be adding to our global positions within the model shortly. The rand does remain oversold, and we will be watching for the risk on trade to return, which is currently still very fragile. Within the asset classes, we remain neutral to overweight local equity, with valuations still very much in our favor and ownership amongst local and global investors now at historical lows. A lot of bad news has essentially been priced in, and there does remain a lot of upside potential within the asset class. Listed property, on the other hand, has run well ahead of itself in Q4, and further upside will be constrained by the recent performance. We are underweight local bonds given the fiscal and election risks, and we find attractive yields in cash with a bit less volatility. On the global side of things, equity is still our favorite asset class, but we are mindful of the path going forward from here. Emerging markets are also screening very attractive in terms of their depressed valuations, but their fortunes are of course tied to the success of China. We remain underweight global property as well as neutral on global bonds, especially given the delay and uncertainty in rate cuts. And global cash is currently still offering very attractive yields, especially coupled with the good opportunities we are seeing in global credit. My co-portfolio manager Rupert and I have been hard at work to align the MFP focused models and the MFP focused fund of funds. The local equity blend has been fully transitioned during Q1 and is now completed. We are currently busy with the final exciting step in the mandate alignments, which involves switching the developed market equity allocation into the Momentum Sustainable Equity Feeder Fund. The emerging market equity exposure will still be executed through Coronation for the time being. That's all from me today, and thank you for your attention.
Thanks, Ronnie. Next up is Keegan Dodo. Keegan is a new face to you. However, he has been part of the Momentum Investments family for a little over 2 years. He is a fixed income fund manager under the stewardship of the more familiar Ian Scott. Keegan will provide an overview of the Houseview fixed income solutions. Welcome, Keegan. The floor is yours.
Thank you, Hugo. Good day, everyone. According to the IMF, global headline inflation is estimated to ease at an average of 6.8 in 2023 to 5.9 in 2024 and to 4.5 in 2025. Global inflation is projected to only be below 4% in 2026 going forward. Inflation remains sticky in some areas due to services inflation remaining high, trade restrictions and geopolitical tensions. As a result, the upside risks to inflations are due to services inflations remaining high in many countries. So when we look at the inflation drivers, a relatively unique feature of the recent cycle has been the longer than usual lag in monetary policy. Research from Bloomberg Economics suggests monetary policy was quick to affect the economy. If this was true, the recent economic resilience highlights structural shifts in demand dynamics. The market conditions to think that dynamics, the labor force changes, and the propensity to spend on services will make inflation remain higher than consensus has indicated. So in the end, whether cost-cutting in terms of cost-cutting in technologies versus the labor market may only reduce inflation to a certain degree. And rate hikes might not cure this inflation problem. The breakdown from the San Francisco Fed Reserve suggests that the recent inflation drivers remain supply-side driven. As a result, global interest rate markets had to dramatically reprice the Fed's interest rate cutting cycle from the expectations of 100 basis points this year to about 50 basis points starting about September. This had the effect on bond yield to rise and reflect the reality of what the market has been pricing in. As a result, the US 10-year had opened the year at around 411 and traded as high as 433 and then closed the quarter at similar levels. Global bonds followed the trend and closed the quarter at elevated levels. The global interest rate cutting cycle seemed to be postponed as a result of sticky inflation and the continued strength in the US economy. And as a result, the Fed had to take a neutral stance on the interest rates. Due to inflation, global yields had kicked up significantly and the base rate had remained higher due to inflation, remaining above the 2% target for most countries and the resilient US economy. Global central banks are changing their policy stance, and we've seen one cut at the SMB. The ECB has guided for interest rate cuts, but the Bank of Japan has started the hiking cycle for the first time in 17 years. On the domestic front, the SARB kept interest rates at 8.5 for 5 consecutive months. The monetary policy outlook remains hawkish due to elevated inflation as a result of food prices due to El Nino drought effects and the summer rainfall areas. The FRA market has repriced that there would be no interest rate cuts in 2024. When we're looking at the 5-year, 7-year, 20-year bonds, so the environment for bonds this year has remained challenging. And as a result, we've seen the market had to reprice significantly higher rates for longer as the Fed has guided that the interest rate cutting cycle will start later. So domestic bonds followed that trend and creeped up higher. SA bonds were further placed on the back foot as a result of the negative effects of our fiscal outlook and government finances, and also, very importantly, the May election outcome. So the yield curve continues to steepen over the quarter, and the risk premium that's priced into the markets remain uncertain as a result of these macroeconomic events. So the 10-year bond traded well above the 12% over the quarter after it started the year at about 11%. The government 10-year bond also reflected this change after trading at 12.31%, starting the year at 11.45%. So the government yield continues to steepen due to these fiscal risks that's embedded in government finances as a result of all these different macroeconomic events. If we just look at the ownership, from non-residents have been selling our bonds since 2018. South Africans' own domestic issues coupled with benign growth has not provided the non-residents with the necessary comfort they need to be able to pour money into the South African economy. However, if there are any positive developments that may occur in the country and non-residents start to send flows back into the country, we could see bond yields trading significantly lower. However, until then, as global yields remain elevated, nominal yields will keep seeing the structural sell-off. The chart provides a summary of the returns from the All Bond Index, the Inflation-Linked Index, and the Cash Composite over a month-to-date, 3 months, and 1-year basis to end March. Cash has outperformed both nominal bonds and inflation-linked bonds over all periods. In the bond market, yields remained elevated across the curve. The yield of the R2030 bond rose 48 basis points, while at the longer end, as a result of fiscal risks, the R2048 increased by 51 basis points. As a result, the ALBI posted negative returns of 2.02%, with the 12-year and 7 to 12-year areas of the curve pulling the returns down to 2.94% and 3.7% respectively. The 1 to 3 area of the curve and the 3 to 7 area of the curve has returned minus 0.1 and minus 1.4 respectively, thus outperforming the longer end. So if we look at the following slide that shows us the credit issuance over the last year and the last quarter of 2024, the term issuance for 2023 stood at 164 billion, which exceeded the estimates of 132 billion. So the year starting 2024, forecast this year is sitting at 131 billion, of which 31.17 billion has already been issued, which makes up about 24.2% of the total issuance this year. The breakdown of the issuance are as follows. Banks and financial institutions issued 10.58 billion, corporates such as MTN issued 10.83 billion, SOEs issued 7 billion, securitizations 1.78 billion, and inward listings just short of 1 billion. When we look at the spread movements over time, the average spread across the sectors have largely been below pre-pandemic levels and continue to tighten. The search for yield is evident in the pricing of the AT1 instruments, which compressed from 590 basis points in 2017 to about 290 in December 2023. The trend for strong credit demand continues within the listing market, and we have seen substantial demand for bank capital, and it looks like there's a yield pickup specifically in the credit market. So this has had an effect on the credit spreads, and it continues to narrow as investors seek yield for credit instruments. Global credit spread has also contracted, meaning that there are opportunities in the market as these spreads have continued to narrow. If we look at corporate South Africa, their balance sheets remain healthy, they remain in a good, profitable positions, and the probability of default remains low from a risk perspective. However, this is one of the asset classes that could have a binary outcome in the event of a credit default. Credit risks within the SOE space and municipality sectors remain unattractive from a risk perspective. The only meaningful issuance we have seen thus far is the issuance of Transnet government guaranteed notes that was well above elevated levels on a private basis, but we still do have concerns around the management around Transnet. From an expected returns perspective, we still expect nominal bonds to be the best performing asset class. However, this is not without risks. The election outcome will have a meaningful impact on how we reprice those nominal bonds going forward, but we do see nominal bonds return anywhere between 9.15 and 13.25%. Inflation linkers, on the other hand, have outperformed nominal bonds on a 12-month basis. Given the slow trajectory in inflation coming down consistently to the midpoint of the band, we expect inflation linkers to return about 7.25 to 9.75%. Credit is the one asset class where demand outstrips supply and credit spreads continue to narrow. However, in the event of a default, yields could see significant repricing and spreads could be much higher than it is today. So we still expect credit to be a good performer, but we could see any returns anywhere between 9% and 9.5%, and cash from 8.5 to 9%. So I think the market is pricing nominal bonds extremely negatively at the moment given the election outcome, but I do believe that the election outcome is not going to be so bad for the outcome of nominal bonds, and the returns we should see should be within the range that we expect, and everything from a structural perspective should be fine. So thank you very much for your time, everyone.
Thank you, Keegan. Next is Richard Stutley, a portfolio manager from Momentum Global Investment Management in London, who will give us an overview of the global portfolios. Thanks for joining us, Richard.
Thank you, Hugo. Now, the theme of the webinar is navigating global elections. And as anyone would tell you, trying to predict the outcome of elections and thus knowing what to do in advance of them is extremely difficult. So what should you do with that information? Well, I think Sanisha's already given us the perfect answer. And that is the fact that she went through and drew up a number of scenarios for what could happen with respect to the SA elections. So we think about a number of discrete scenarios, we assign probabilities to them, and we think about how portfolios might behave in those different scenarios. That, I would suggest to you, is the way to approach some of these very hard to predict events like elections. Now again, as Sanisha says, it is a busy electoral schedule, election schedule this year. How is it most relevant for us when thinking about our global portfolios? Well, you know the big one that is coming up, 5th of November in the US, the electorate go and vote for a new president. Relevant because obviously the US represents of the order of 25% of global production. That's why it's such a key economy. What can we say sat here at the start of May about what's going to happen in November? Well, I'd suggest to you it's very difficult to predict what the landscape is going to look like then. Particularly difficult when you think about the age of the two key candidates. Particularly difficult when you think about the ongoing litigation faced by one of those candidates. So I think it is difficult at the moment for us to come up with those scenarios and start assigning probabilities to them. Rest assured, as we get closer towards November, that's precisely what we will be doing. And at the moment, the one key thing we have noted is that we think a Trump presidency at the margin would be slightly worse for European economies. And we say that because we think Trump would be looking for a lot more spending on defense by those big Western European economies in the event that he wins the election in November. So we've got that election, obviously, to think about. The other one that's somewhat relevant, it is more so if you're me, sat here in London, is UK elections. Less relevant because, of course, the UK only represents around 3% of global GDP, so an order of magnitude smaller than the US. Nonetheless, somewhat significant. I can tell you, as things stand, we don't yet have a date for said election, and therefore we haven't started thinking in detail about those scenarios and those probabilities. But I say again, I think what Sanisha did there is the way you should approach these type of events. Okay, it is a quarterly presentation, so let's start to think about some of the recent moves we've seen in markets. As it says there in the title, recent market returns have been dominated by equities and gold. We're showing three different time periods for each of these asset classes on this slide, and you'll note with equities on the left-hand side, gold towards the right-hand side. Over all these time periods, their columns are pointing right upwards, just indicating good performance. I think we know what's been driving equities. There has been this excitement around AI. What's been going on with gold? Well, again, it comes back to politics, not in this instance elections, but let's call it the hard politics of war, and that's everything that's been going on in the Middle East with Israel and Hamas. In terms of our scenarios there, the key one we worry about is that this grows from being something of a sideshow into something much more meaningful that draws in major players on either side in the form of the US, Russia, China, more in support of Iran and by extension Hamas. Thankfully, that scenario still carries a very low probability, and so while everything that's been going on in the Middle East and what continues to go on in Eastern Europe, whilst those are significant, I'd suggest to you they're not currently the most significant factor behind markets. Just looking in a little bit more detail at the returns of equities on this slide, what you'll notice is, yes, it has been, as it says in the title, dominated by the IT sector. I've already touched upon that. But if you look at the columns showing year-to-date returns, you'll note that actually there's a few sectors doing better now. And some of that, if you take energy on the left-hand side, that again is back to politics. That again is back to the Middle East driving oil prices up above $85 per barrel. Things like banks, that's more to do with the changing outlook for interest rates, which I would suggest to you is the most important theme. And that's what I'm going to touch on next. What are we showing on this slide? Simply the fact that across these different maturities, 2 years, 10 years, also looking at inflation-linked bond yields, they've all been moving up. Now, last time I did this recording, I probably spoke to you about the significance, I thought, of a 4.3% yield on the US 10-year, and I say that because 4.3% to us looked about fair value. And what we've seen most recently is actually US 10-year yields moved through that. You probably know that as I stand here today, that yield's moved up to more like 4.6, 4.65%. So yields has moved up. Why? It's down to the inflation picture as shown here. Now you probably know this, inflation in the US, that key economy, it has stalled, i.e. that deceleration in inflation. Well, the picture doesn't seem to be getting any better, at least in the last few months of data. Why is inflation still stubbornly high? Some of the factors we'd point to would be strong non-residential investment, so that's by and large investment by companies, and also this big fiscal impulse that, yes, it's fading, it's less strong than compared to recent years, but it is still meaningful and it is still there. Now, this inflation dynamic, this sticky, problematic inflation, this does look to be more of a US problem. We had inflation data from Europe just the other day. That was less problematic, but nonetheless, high US inflation means high US interest rates, and that is a problem for other economies. It's very difficult for Europe to envisage reducing interest rates, or indeed an economy like South Africa to envisage reducing interest rates when US interest rates are still that high and representing a great destination for capital. Why inflation? I touched on a few of those things, including the outlook for fiscal policy. The other one is that we've still got this very tight US labour market, and that's all we're showing on this chart here. All of these indicators, which are tracking things like wage growth, job openings, and indeed the overall unemployment rate, they're all moving in the right direction. I wrote a blog about this recently, which you can read. So they're all moving in the right direction, i.e. there is progress, but clearly not enough progress. So we've touched on the Middle East. It is significant, but it is not that significant because currently it doesn't involve the big global players. Instead, I've said what is significant is this rise in yields, and the easiest way to think about it is that US 10-year moving from 4.3 to 4.6. So take these factors together. What does it mean? And should we be looking to change anything that we're doing currently in terms of our positioning? First question, I'll explain this slide in a minute, but I'm using this slide just to ask the question, are equities going to keep leading the way? We saw it earlier, equities outperforming quite significantly pretty much all other asset classes. Do we think that's going to continue to be the case going forward? Well, first of all, per this chart, let's acknowledge the good factors that have been driving equities. And the most significant is that headline economic growth has been stronger than most people predicted, stronger than I predicted. What we're seeing here is measures of activity across the US, the UK, the Eurozone, etc. And all of them are reasonable. They're not great, but they're reasonable and they're better than I thought they might be at this time of the year. So that's the positive aspect that has been driving equities higher. But the bigger part of what's been driving equities higher is simply valuations, call it prices paid, i.e. equities are getting more expensive. They're more expensive today than they were at the start of this year. At the start of this year, they were more expensive than they were 12 months previous. So that cycle of things getting more expensive, that can't necessarily, or I certainly wouldn't expect that to go on indefinitely. What does that mean? I'll go on to show it later, but I'm not saying sell all of our equities by any means. We still have decent allocations, but should we be underweight today? We think we should be. Second question I'd pose, yields have moved up from 4.3 to 4.6. Remember I mentioned, is it time therefore to buy more bonds? Good question, seems logical, those bonds now being somewhat cheaper and yielding more, but actually I'd say no, those yields are justifiably higher, i.e. something has changed. What has changed? Well, it says there in the title, the expectations for interest rate cuts have been reduced, i.e. we don't think interest rates are going to come materially down from where they are currently at around 5.3% in the US. They're not likely to come materially lower in 2024, and a similar picture is repeated across the EU and UK. So yes, we'll get cuts, but not that many, we think. And so by and large, we think that expectations where interest rates are going to go that are embedded in bond prices today, they look fair to us. If they looked wholly unrealistic and far too high, those expectations, then we would be looking to buy more of those bonds. But actually, what has changed is the inflation outlook, and therefore I'm moving my assessment of what fair value is from 4.3% up to 4.6%. So you add that together, here is our asset allocation views, and based on what I've just said, none of this should come as a surprise. Equities, we still think we should be a couple of percent overweight. Bonds, looking more like fair value, so let's stay neutral there. Where then are we spending that small underweight in equities? We're spending it in alternative areas. That includes things like private equity, private debt, aircraft leasing, lots of these areas that are somewhat esoteric. They're harder for the average investor to understand, and we think currently where pockets of the equity market are overvalued, these areas in part are extremely attractively valued and underappreciated. So that's where we're spending that small underweight. Cash, again, with the US cash rates around 5.3%, that's very decent, so cash is neutral. Add it together then, our outlook summary, our base case still sees inflation coming down to central bank targets. We don't think central banks have lost this war. We don't think monetary policy tools like interest rates, they don't work anymore by any means. We do think, however, it's going to take time, and so you're only going to see a gradual reduction in interest rates, and hence any investment that's predicated, only looks like a good idea on the basis that interest rates come down from 5 to closer to 3, we don't think that looks like a great investment. And you could argue that parts of the equity markets are really priced on that expectation of a very quick decline in interest rates. The economic outlook, that second hexagon, it's highly uncertain, and it's uncertain because of risks associated with sticky inflation, high interest rates, and of course geopolitics, which aren't going away. So you add that all together, we're suggesting we should just be a little bit cautious as things stand, a bit of an underweight to equities, plenty of cash. But equally, I'm not suggesting we need to be wholly fearsome. I'm not suggesting divest everything. And that's because you've still got cash rates, as I mentioned a minute ago, of 5.3% in US dollars. Now is the time to be invested because yields across cash, bonds, parts of the equity market, all of them are very attractive and therefore offering decent prospective returns in our view. So final slide from me, it is, as I say, a quarterly presentation, so just touching on the performance of the funds, Momentum Global Cautious, Global Managed and Global Growth, all of them delivering positive returns in the first quarter, ranging from 0.3% up to 5.1%. That spread is marked because equities on the one hand did extremely well in the first quarter and bonds on the other hand did very poorly and delivered negative returns. That's where you get that spread. Over 1 year, the fund's looking very much like themselves, returns ranging from 4.5% up to nearly 15%. There you have it, that good period for equities. And that is having the effect of rebuilding those longer term returns. So over 5 years, over 7 years, as I say, the fund's looking very much like themselves. A little bit of work still to be done on cautious, where that 1% return per annum over 5 years, that needs to be a bit higher, but we're moving in the right direction. Over 3 years, still some negative numbers, but as I say, quarters and years like we've just seen help to rebuild that. With that, we have the important notes you can read at your leisure, and it just remains for me to say a big thank you for joining us. So thank you.
Thank you, Richard. Martiens Barnard, our Head of Technical Marketing, will now unpack the key retirement risks and discuss how you can add a level of income certainty in your clients' retirement portfolios. Welcome, Martiens. We all look forward to hearing your presentation.
Thank you, Hugo. Hello, everyone. I've always wanted to start a presentation with a Hollywood quote, and today is my chance, so here goes. Gentlemen, you had my curiosity, but now you have my attention. So potentially not the ultimate delivery of the quote, and I'm definitely not Leonardo DiCaprio, but it's definitely the most fitting quote for today. Because over the last 2 years, we've done various presentations to show you the power of using a hybrid annuity. And I will briefly reflect on that today. But today, I want to showcase the latest research on using hybrid annuities in retirement. And I hope that the research would change the way you imagine retirement. In May 2022, we launched the hybrid annuity, and we spoke about the living annuity risk spiral and how longevity and market risk creates a lot of income uncertainty for retirees. And here, we show that for retirees who live to an advanced age, how the high return from a life annuity can improve their income certainty and reverse the living annuity risk spiral. Then in September 2022, we launched a Securing Risk white paper about retirement income, and in this paper, we introduced something called an income map. As a quick refresher, an income map is sort of a probability map that shows how our fictional client Greg, at for instance the age of 90, would have about a 50% chance of getting the full income that he wanted and about a 40% chance of getting less than half of the income that he wanted, depending on how markets performed. I'll get back to this 40% a bit later. Then, in October 2023, we launched Retirement Reimagined Phase 2, where we introduced something very similar to an income map called an inheritance map, so that we could look at both income and inheritance certainty. By looking at it in vertical slices at the ages of 70 and 90, the chances of Greg having grown his investment in real terms would have been just over 40% at the age of 70 and about 30% at the age of 90. But the chances of his real value of his investment being less than half is more than 50% at such an advanced age. And when looking at it holistically, we show that a traditional strategy has a lot of red on the income and the inheritance map a few years into retirement. And by introducing a hybrid annuity with a 35% exposure to a gap, we could almost remove the red from the income map, which of course means a lot more income security. But this strategy had an adverse effect on the inheritance in the early years. As you can see, there's a lot less blue, a lot more white, and a little bit more red in the initial years on the inheritance map. This is because a gap does not have an inheritance value. To counter this potential inheritance shortfall in the initial years, we introduced a gap with the maximum guaranteed term. And here you can see the inheritance map being similar or slightly better than the traditional strategy, yet there was still an improvement in the income certainty, as can be showcased by the reduction in the red area. Not as much as the pure gap, but still an improvement in income certainty. And then shortly thereafter, we launched the Income Illustrator. I'll speak more about the Income Illustrator towards the end of the presentation. So let's talk about some of the successes and about some insightful facts about the living annuity book on the Momentum Wealth platform. We've seen that currently approximately 60% of hybrid living annuity sales is done with the use of the income illustrator. That we pay approximately 5 billion rand in income from our living annuity book. That the long-term IRR on our living annuities is close to 8.2%. And today we're going to dig a lot deeper into that number. That approximately 30% of our assets under administration is in living annuities, and that MFP has assets under administration of close to 16.5 billion rand. And lastly, we can say that if we assume that financial advisors are taking a 0.5% trail fee, that we will be paying financial advisors 380 million rand for the advice that they're giving on the living annuities. But today, our focus is on 4 key retirement risks and how it has played out on the Momentum Wealth platform. We look at income drawdowns, behavior tax, and 2 tightly coupled risks, longevity and market risk. Let's start with income drawdowns. This is a distribution of income drawdowns on the living annuity book with the tail ends removed. The first thing that I wanted to do here was to give these bars different colors in accordance with the risk that the annuitants are taking. But you can't do that because a client age 80 and a client age 60 that is both drawing 8% from their living annuity are in very different financial situations. And therefore, we needed to bring age into this equation. And now you can see not only the number of annuitants across income drawdown levels, but also the number of annuitants across income drawdown levels as displayed on the vertical axis and according to their age on the horizontal axis. But this does not yet tell the full story in terms of risk. By mapping the required return needed for each of these cohorts of retirees as another dimension, we can start to see the risk that these retirees are facing. Let's dig a bit deeper by using the original case study, that of Greg, who is a 65-year-old retiree and who is drawing 7% from his living annuity. Now, Greg forms part of this orange bubble, which means he needs a net of fee return of about 11 to 12% to maintain his income in real terms. If we add fees, we're probably talking about a 12.5% to 13.5% return that is needed. And as you know, that is an extremely high return that surely is not always attainable. What we also see from this graph is that there are not many retirees in the dark green or in the light green cohorts. These are the retirees that are drawing income at a responsible level. Clients in yellow is starting to take on risk, those in orange is taking on significant risk, and the clients in red is probably already in the living annuity risk spiral. What we can also see from this is that at, for instance, the 7% income drawdown level, if you're 80 years old, you have a dark green required return. Here, your capital really exceeds your income need. But at the age of 70, you're in the yellow cohort, implying you are taking on a lot of risk as the gross of fee returns that you need is already in double digits. All the ages below that are already in the orange cohorts. So the fact of the matter is, for the same level of income drawdown, at the earlier ages, the risk or the required returns are much higher than at later ages. When looking at the retirees in our book in terms of the distribution of required return they need, we are looking at about half of them needing a 9 to 10% net of fee return. From a gross of fee perspective, we see that about half of retirees need double-digit returns to maintain their incomes in real terms until the age of 90. That is the first risk. The next risk is also one that the retiree has some control over, and that is the risk of paying a behavior tax, making switches that is to your disadvantage. One of my colleagues, Paul Nixon, our behavioral scientist, has done a lot of research to quantify the detrimental effect of switching behavior on the wealth platform. By using unsupervised machine learning techniques, the algorithms identified 4 archetypes or 4 similar groupings of investors. And these are called market timers, assertive investors, anxious investors, and avoiders. In short, the behavior of these archetypes looks as follows. The avoiders don't really take on investment risk, and when they do switches, they switch between conservative funds, and therefore they don't destroy that much value in the process, yet they still do. Anxious investors, on the other hand, are making switches when markets are falling, and due to the switch, they tend to miss out on the market recovery. Assertive investors generally pay behavior tax when markets are performing well. They tend to switch to investment funds that has performed better than their own funds in the recent past, but unfortunately, this also destroys value. And then you get the market timers. They are doing switches when markets are falling and when markets are rising. This behavior tax has been quantified in some periods to be as high as 4% per annum. And you can see here that the market timer, for most part, pays the highest behavior tax. Yet, the assertive investor consistently pays behavior tax, well, at least for the last 4 years. And why is that so important today? Is because we see that about 75% of behavior tax is paid on our living annuity book. And there could be various reasons for this. For instance, retirees don't have any recourse. They don't have years in which they can build up a new retirement fund as they don't earn a salary anymore, inducing a lot more fear, which leads to bad behavioral switches. Also, because these investors are drawing an income from their investments, the chances of them seeing a lower market value at the end of the year has as much to do with the return of the market as it has to do with the income they are drawing. Again, this leads to higher levels of anxiety and to behavior. Moving to market and longevity risk, these risks can stay hidden in the initial years of retirement. If we imagine the green areas here implies a person can maintain his retirement lifestyle, you can see that if we look at the horizontal axis, the period how long a retiree is able to maintain it depends on how well the markets are performing. At point number 1, we show that under weak market conditions, the retiree could maintain the income in the initial years, but not for a sufficient period of time. At point number 2, we show that in average or even strong market conditions, retirees might still run out of income when they live to an advanced age. Essentially, market risk, and specifically longevity risk, do not immediately show itself in a retiree's income. It takes a while. For a lot of retirees, these two risks can also occur simultaneously at point X, leaving them in a situation of leaving a negative inheritance. To put numbers to this, again using Greg, who is drawing a starting income of 7%, he would need a return of 8.8% to maintain his income for 15 years. For 25 years, he'd need a return of close to 11%, and for 35 years, close to 11.5% net on a net of fee basis. This is probably closer to the high end of 12% or maybe even 13% that is needed. This is difficult to achieve, and the risk that accompanies this type of expected return leaves retirees at the mercy of the markets. When looking deeper into longevity risk, I was surprised by the initial analysis. Seeing the age of our annuitants on our book, I was thinking I would see a lot more people in the high 70s and 80s. But then I realized that living annuities have not been around that long. And if you look at the years since the inception of our living annuities, we can see that about half of them have been purchased in the last 7 years. Therefore, it's understandable that the age distribution of the annuitants are still reasonably young. And thus it can be said that living annuities are still a new generation product, as longevity risk has not yet shown its effect in the retirement landscape. This means that retirees that are under pressure are more likely to be under pressure due to the low levels of pre-retirement savings or low market returns than they are under pressure due to longevity risk. Looking at market risk, I want to start by talking about the concept of sequence risk. Let's assume I've got 2 people investing 110 Rand. If the first person invests in a sideways tracking market, his value would not change. It would still be 110 Rand. But when the markets follows a sequence of first performing negatively and then positively by minus 25% and 20% respectively, he would still be in the same situation and also under the reverse of the sequence. Yet, the second investor draws an income, the sequence of the returns matter. If he draws 10 Rand in a sideways market, the 110 Rand ends up being 100 Rand. But if the sequence is first negative and then positive, he doesn't experience the full recovery and he ends up with less than 100 Rand. Of course, if the sequence is in the opposite, first being positive and then negative, he actually could be in a little bit of a better situation. And that is sequence risk. Of course, it can also work in your favor should the sequence be positive first and then negative. Why am I saying this? Because I want to look at the JSE returns over the last 2 decades, and then this sequence risk is going to be very real for you all. If we look at the annual returns of the JSE Top 40, you will see that the average return in the first 10 years of this analysis was about 21%, but the average return in the last 10 years was less than 10%. If we take these individual annual returns and we turn them into long-term cumulative returns, we can see not what happened in the individual years, but over long investment periods. If you look at the first bar on this chart, it shows the return experienced by someone that had invested in 2004 and remained invested until the end of 2023. And here you can see that again, the total return over the investment period for someone that have invested years ago and remained invested until now is better than investors who had invested more recently. Thus, sequence risk has played in favor of retirees who had invested many years ago. Before I move into the next slide, where I will move from general market returns to actual investor returns, I want to make 2 points. Firstly, the average investor returns that you will see on the next slide is a few percentage points lower than the numbers that you're seeing here. But that is expected. Why? Well, mostly there's 3 reasons for this. Here we are looking at index returns, and that is like looking at a net of fee return, where actual returns are gross of fees. Also, there is no behavior tax in these numbers because this is just index numbers. And then lastly, we need to understand that investors aren't fully exposed to the JSE. They will of course have conservative assets in their portfolios which rarely can provide double-digit returns. That was the first concept that I want to talk about. The second concept is a concept called a percentile. Now what is that? So let's just imagine we are 800 people in a room and I ask you all to stand from the shortest to the tallest. Then person number 8 in this row would be the first percentile. It means that 1% of the people in the audience is shorter than person number 8. Person number 80 would be the 10th percentile, meaning that 10% of the audience members are shorter than him. And why am I explaining this? It will be clearer in the next slide. So what you see here is the return percentiles or the IRR percentile points of the investors that had invested in each of the calendar years from 2003 until 2022. I use 2003 as this was how far back I could get life annuity rates, which I will use later in the presentation. That's just the reason for the graph starting there. But now, if you look at 2022, the 10th dot from the bottom is the 10th percentile, and it sits at about the 5% line. This means that 10% of the investors that invested in 2022 had thus far had an internal rate return on their investment of less than 5%. That's of course up to the analysis date, which was February 2024. The blue line represents the 50th percentile, and that means that 50% of the investors from the 2022 group had a return of less than, it's about 8% on their living annuities. So by the way, looking at 2015, about 50% of investors experienced a return of less than 5% over this time period from 2015 till Feb 2024. And also, for 6 of these calendar years, hardly 1 out of 100 investors had experienced a return in excess of 10% from when they invested until Feb this year. Overall, the average IRR experienced was about 7.1%. But I want to focus on those investors that has been invested for the longest period and who also had the benefit of sequence risk. Their internal rate of return averages at around 8.2%. And I want to draw a case study from these above average set of investors. But before that, with this actual experience in mind, let's look back at an earlier slide. Greg, a client aged 65, was drawing an income of 7% from his living annuity, implying he needed a return of 11 to 12%. What are his options should markets perform similar into the future as they've done over the last many years? Well, he would probably need to reduce his income drawdown from 7% to 5% to give himself a reasonable chance of a successful retirement. That is close to a 30% reduction in income. Yet, look at what a life annuity is currently offering. 10%. Why do I say 10%? Well, a gap gave about 8,000 Rand per month when using a 5% escalation, specifically for Greg. That is 96,000 Rands per year, which equates to a 9.6% or rounded up a 10% starting income for the year that of course escalates in line with my inflation assumptions. And that is why a hybrid annuity can give so much more income certainty. Let's see this in action. Today our case study is John Doe, a male with an ID number that starts with 48. He initially invested 1.8 million Rand back in 2003 and is now 76 years old, and his current investment value is around 1.3 million Rand. When he draws a statement, he will see an IRR of 8.25% since the inception of the policy. This is an above average return from an actual client. Now let's assume that our hybrid annuity was around in 2003 and that John had invested 900,000 Rand into a gap at the rates available as in 2003. Note, the rates were lower in 2003 than what they are today. John would have been able to purchase an income of 4,000 Rand per month, escalating at 5% every year with this 900,000 Rand investment into a gap. Now this is the actual performance of the living annuity. The red line is the market value over time, and the red bars is the actual income that John drew. You can see there that a few years in, John had to really reduce the income he was taking from his living annuity and keep it there for a very long time before starting to slowly increase again. Now, I'm going to show you a theoretical market value, and that is the dotted line that I've built up using the actual IRR. Why am I showing you this? Because you can see that it is lower than the actual market for most part, as John essentially benefited from the sequence of market returns. Thus, he had better performance in the initial years than in the latter years. In the next slide, I'm going to show you what would have played out had John purchased the hybrid annuity in 2003, starting with the market value. But note, John's market value would be half on day one, as the gap does not have a market value. But what is interesting is that his market value is playing catch up, and instead of being 1.3 million Rand, it would have been around 1.2 million Rand. And in actual fact, if I look at the income payments, we can project that the market values would cross over in 7 months from now. Why do I say this? Remember, a client receives a single income, whether we're talking about our hybrid annuity or a pure living annuity. This is the red line that you're seeing there. But the pure living annuity is paying 16,000 Rand per month from its market-linked assets, and the hybrid annuity is only paying 3,000 Rands per month from its market-linked assets, the 1.2 million Rand, as the gap is paying 13,000 Rand into the living annuity every month, and that is used to fund the the full 16,000 single payment that is made to the client. And if you do the calc, the 13,000 times 7 is more than the difference in the market value. The next 12 gap payments would create an excess of more than 60,000 at the age of 77. By the time the client turns 80, the extra value generated would be more than 600,000 Rand. At the age of 82, 1 million Rand. At the age of 86, 2 million Rand, 3 million Rand at the age of 90, and at the age of 95, extra value in the region of about 5 million Rand. But the hybrid annuity does not only offer significant protection for retirees, it also does so for financial advisors. I've plotted in here the value on which the financial advisor's ongoing commission is calculated. This is of course the market-linked assets, the blue line, plus the purchase price of the gap. At first there's no real difference, but in the latter years it really holds up better when markets aren't performing very well. So that's the end of the case study. I want to urge all of you to please go onto VIA to view the income illustrator, as it can help you display to your clients how you can improve their retirement outcomes. When on VIA, please choose Product Providers, Momentum Investments, and then under Tools, the Income Illustrator. The Income Illustrator opens on your living annuity clients that needs to be reviewed in the next 3 months. You can also view other clients or load new clients. Its 3-step process is very easy to use. You enter the client's objectives, basically the net of tax income that is needed, the income escalation, the planning age, and the importance of inheritance. The Income Illustrator then generates market realistic return simulations to show you what the current situation would be and how it will change when you introduce a gap. It automatically provides an estimate of how large the allocation must be to the gap, but it gives you, as the financial advisor, the power to personalize the allocation to suit your client's personal financial needs. The illustrator gives you a view into 4 metrics that can help you facilitate your conversation, and in the 3rd step, it provides a summarized view of these metrics across the various scenarios that you considered. So in summary, by introducing an asset class that is built specifically to protect against longevity risks, which gives a very high return to those retirees that live to an advanced age, we believe that you have the power to reverse or partially reverse the living annuity risk spiral. And now you are able to illustrate this to your clients by using the Income Illustrator. And I hope that if perhaps I've had your curiosity on the hybrid annuity before, that now I have your attention. Thank you.
Martins, you certainly had my attention. With all the uncertainty in the current investment environment, I believe that an asset providing a level of certainty in securing my income is invaluable. Thank you for the insights. And that concludes today's Outcome Matters. From my side, thank you for attending. I trust that you have found some key insights and value in today's content, which can translate in meaningful discussions with your clients. Before I say goodbye, just a reminder to watch the full session and add your ID number to the CPD section so we can verify your attendance. And that our event platform will remain open until the end of June for you to still view this event and still receive your CPD points. Until next time, goodbye.